And now to our market monitor, who likes dividend-paying stocks that he says should benefit from consumer spending. The last time he was on in April, he recommended 3 ETFs. The S&P Aerospace and Defense ETF, which is up 2%, the Spider S&P Capital Market ETF, which is down 10%, and the iShares North America Tech Software ETF, which is 7% higher. Joining us is Mark Luschini. He's the investment strategist at Janney Montgomery Scott. Good to see you again, Mark. Welcome back.
Thanks, Sue.
Let's start with your first one, Carnival, as in the cruise line. It has a pretty nice yield.
It does. It has above a 3-handle yield, which I think is still pretty appealing, that is, even as we've seen this bump in interest rates of recently, but particularly when compared to the S&P 500 at less than 2%. And it's benefiting from flows of traffic. Both baby boomers and millennials that are flush with cash are seeing wages increasing, like you've talked about in most of your segment here today, and are looking for experiences and chances to get away from the hustle and bustle. And Carnival is, I think, a good name with a healthy dividend, and I think in a good position to take advantage of that.
Tapestry, the old, used to be called Coach, of course. I haven't often thought of it as a dividend play, but it has a 3% yield right now, and it had an up and down year in the stock market as well. Why do you like it here?
Well, Bill, of course, it's a discretionary stock, and that space has been buffeted by a bunch of different issues over the course of the year. But the fact of the matter is, it's an aspirational purchase brand in the form of Coach. Recently bought Versace to continue to build out its portfolio of offerings. And again, I think because the consumer continues to win by way of seeing wage gains, they have confidence in their jobs, feel good about what the future looks like through confidence surveys, all leads me to believe that consumption is going to remain a positive impulse for the U.S. economy, and they're going to stand to benefit from that same thesis.
And I would assume, if that is correct, that our next pick, Walmart, would do the same.
Yeah, besides the prospective windfall from their lawsuit that you just talked about, I still think, of course, they're a retail giant, general merchandiser, competing very effectively, by the way, against Amazon by way of their e-commerce initiative, which is big and fast growing, and therefore I think, again, is well positioned to address the consumer needs from those affluent to less affluent alike.
On that note, Mark, thank you so much. Mark Luschini with Janney Montgomery Scott. And as always, to read more about Mark's picks, you can head to our website, which is nbr.com.